So I'll get set up with my disclaimer and then I'll hand it over to you. So.
Yeah, perfect.
Manohar, can you unshare for a second? Then looks like I can't share over you. So yeah, thank you. All right, we'll go ahead and get started. So welcome to the webinar. We'll start off first by just sharing a quick disclaimer from GPTA. Please take a few moments to read through that, and then we'll get going with the webinar. I'll give you a few seconds to read through. Okay, let's go ahead and get going with the webinar. So welcome all. Our speaker today is Manohar Samagaru. Manohar Sama is a licensed financial services professional. He has done his MBA in finance and marketing from the Keenan Flagler Business School of UNC Chapel Hill. Manohar brings his wealth of experience and expertise in helping families plan for their financial security through various financial solutions, such as, if you're not talking, can you please put yourself on mute? Thank you. So Manohar Garu, he helps families plan for their financial security through various financial solutions, such as tax-free retirement solutions, kids' education planning, protecting capital of your retirement savings in these highly dynamic and volatile market conditions, and in an uncertain future. Currently, he's licensed in the states of Oregon, North Carolina, Maryland, Texas, Pennsylvania, Georgia, New Jersey, Indiana, and is expanding into other states. Without further ado, let me hand it over to Manohar Garu. Please go ahead and share and walk us through your slides.
Thank you very much, Sridhar Garu. Appreciate the great introduction. First of all, let me recognize and appreciate the efforts and coordination by Mr. Ramesh Garu and Nirupama Garu, along with Ravi for sure, and with the support from all the people of GPTA members. I hope
were you able to hear me?
We just lost. Yeah, now we can hear you.
Okay, great.
Okay, great. Sorry.
Yeah,
I was.
So is it
resounding?
Yeah, we are hearing a disturbance on the line.
Yeah, it's seeing noise.
Yeah.
Okay. All right. Is it better now?
Much better.
Yeah, it is better.
Yeah.
Okay, great. Awesome. All right. Thank you, Sridhar Garu, once again. First of all, I would like to extend my wholehearted appreciation for Mr. Ramesh Garu and Nirupama Garu for inviting me for conducting this live webinar on financial planning for the GPTA members. And it's been a pleasure coordinating with all of you so far. And I would like to really thank both Nirupama Garu and Ramesh Garu and Ravi Garu for this opportunity. And here, as Sridhar Garu introduced me in the beginning, I'm a licensed financial services professional, and I have done my MBA from UNC Chapel Hill. Basically, I do my full-time job in a non-IT industry. I'm a little bit of an odd man out, but I'm into the business management side, primarily into industrial automation and robotics industry primarily. And that's my full-time job, basically. But I do all this financial planning and financial services on my spare time and basically over the weekends, and trying to make it as a full-time profession over a period of time, definitely. And here, since because of the logistics, obviously, I have to share my own disclaimer. I'll give a few minutes while you can read it. And if you have any questions, we can take it at the end of the session. And another logistics-wise, feel free to post your questions or anything in the chat box, and a few people, the organizing committee is going to monitor the chat box and compile those questions, and we will answer pretty much as possible at the end of the seminar. And if it is a relevant question in the middle of the session, you can go back and address any of those topics if required. Since we have almost about 90 minutes, I will try to wrap up my presentation in about 60 to 65 minutes or so, and then we have plenty of time for Q&A at the end. So just read the disclaimer for about 10 seconds or so, and then we'll get started. All right. So today's webinar is going to be focusing primarily on personal finances and wealth building strategies, and the taxes primarily, and income and healthcare in retirement. Especially most of the people kind of are planning in retirement and all those things, but key aspects of taxes, income and healthcare are very, very key during our retirement primarily. And then another major topic that's really close to heart for many people is the kids' college education planning and finances in kids' college education, etc. And then finally, estate planning. So we are not professional lawyers or anything, but we would like to touch base upon the estate planning, which is very, very critical if we are all living in this state of America, basically United States of America. So these are the 4 topics which we will run through. And then again, I would like to remind for the new joinees, please feel free to post your questions in the chat window, which are going to be monitored and taken care at the end. So everybody, primarily when it comes to the personal finances, okay, probably many of you are taking care of your own personal finances better than anybody. And we all believe that we are the best managers of our money. Obviously, no doubt about it, because we all know our situation, our family situation better than anybody else. Okay, so we are best money managers. But when it comes to really a little bit of a deeper thinking, so what we really mean by personal finances, okay, it could start from wealth building to, you know, we all go through life stages in a different stages of the life. From, let's say, as soon as we graduate or come to US for masters, or somebody come on H1 for the job, etc. We all go through different requirements. But money is the common thread all across through the life, okay? But that money requirement changes. It's kind of a shape, size, or whatever you want to call it, through stages of life as we are passing through. And then requirements are kind of a highly demanding at some time, okay? But if you are not prudently managing your requirements, then we can get into some kind of a serious trouble. But money is not the only solution, but lack of money can raise a lot of questions in life, okay? Definitely. But we are going to really face so many things when it comes to the personal finances. We want to have income, obviously, and then we would like to make some investments for a rainy day, and then obviously take care of our family and kids, provide some kind of a security, and then retirement planning. So many things are coming into personal finances. But let me ask you, how many people are really comfortable asking very kind of a wholeheartedly introspection wise, people are how confident they are? What is the main influencing factor for them to take care of their own finances? Okay, either they are influenced by colleagues or friends, family members, neighbors, community. But how many times really people are really confident that they can take care of their money management point of view? Okay, people get lost and people get confused. Most of the time, majority of the time, people follow a friend or a neighbor or a family member. Okay, they seek an advice and they tend to cross-verify through the social media or whatever the online search, and they tend to get influenced by verifying all those things. Many a times, people don't even go to a financial professional. Okay, but there are key aspects of this basically, which we'll categorize into 6 basic steps. when you are really looking into security and building the generational wealth, basically for your family for future. And then all these 6 steps can be kind of taken into consideration with your own judgment, obviously, because it has to suit your final family's requirement. Okay. But the success of the financial independence or financial lifestyle basically depends on how much knowledge you personally have, because we are not a financial professional, most of us, but we again try to manage our own finances. Lack of knowledge could lead to so many issues also within the financial world. Okay, that's why very few people seek the guidance and advice of a financial planner. But really, let me ask you one couple of questions, very basic fundamental questions here. When was the last time some of you or all of you, each one of you have visited, okay, a financial planner and discussed about your real financial needs and a lot of things, as I was saying, about the plan for your retirement? Other than 401k investment, which is kind of a company offer, how many people really plan for a retirement? Have you ever visited a financial planner himself or herself, basically? Okay. And the fundamental question again I will ask is, really, do you have a financial planner at all? Okay. If less than 2% of the people have a financial planner, and less than 0.5% of them visit them or review the financial plan every year, okay, with a financial planner. But I'll correlate this with our medical exam, okay? Since the companies are asking us what are the annual exams or whatever the executive health checkup, we go to our physicals and all those things annual to a doctor. But don't you think that as much important our health is finance anything less? Then why do we neglect it? Okay, so this needs to the paradigm shift in the mindset and the way we think about the finances needs to change for most families. Okay, all right, let's look into what are those 6 steps. Here it could be related to money management or cash flow, or if a very young family coming out of college or coming from US and settling up a new family here, debt management could be another one. And emergency money, emergency fund, okay, in case of a rainy day, in case of job loss or furloughs or layoffs, okay. And then what are the money we are really saving or earning over a period of time, how well it is kind of managed in terms of building that wealth or making that translating into a wealth, which will be able to help you or build to really create a fund that will serve your generations to come, okay, in a smart way. Then how much of that wealth you're building is protected in a proper way, okay? And then is it kind of preserving it, or is it going to get diluted over a period of time or lose its value from taxation, changes in taxation and all those things, okay? Like many people don't even have an estate, okay? Estate plan is not created. So some of these things have to be really taken care. Predominantly left side of the 3 points are kind of a short term to mid term, I would say, but the right side 3 bullet points are primarily for long term, and this is really long time. And most of us do not have that vision and create that plan for long term financial planning point of view. But let me put it this way: is everybody not so successful in money management? Definitely not, because every family's needs, situations are different, and everybody may not. 100% of them may not be needing all the 6 steps, but at least some, 1 or 2, or maybe all of them, they may be requiring. Okay? During the presentation, we'll try to address as much as possible some of these points, and then we'll probably individually you can correlate what is relevant for your own situations, and then we can go into one-on-one consultation if required. That's different. But when it comes to money management, definitely there are 2 sides to it. Okay, one is the income side, second is the expenditure side, obviously. Okay, and then most of the time, what happens is we try to focus on typically. Okay, if you're doing a job, a family is having 2 income, they tend to have, okay, this is our income. Okay, let's say, and then the expense side. So we always focus on how to reduce expenses or how to optimize the expenses. But let me ask you one quick question here. Okay. What is your biggest expense? You can post your answers in the chat window, and then we will monitor the chat window, no issues. Okay. But if you're really serious about this, post your answers in the chat window. What do you think is your biggest expense today? Many people think probably it is education. Many people think maybe lifestyle, or maybe a mortgage or a rent if you're renting it, whatever it could be. Okay. Many people, I mean, I would say more than 95% of the people think it is pretty much kind of a mortgage or rent is their biggest expense. Okay. And probably that is their outlook, because every time those who are really in working life, especially salaried people, they negotiate their salary like a package. No one negotiates a salary like after tax dollars or anything. Okay. So let me share, the federal tax is one of the biggest expense. Okay. Because that is not seen, because whatever the money that comes to our bank is after tax dollars. That means the Uncle Sam is taking his share before he's kind of paying us. Okay. So he takes his money first. Then the state government takes their taxes. Lucky some of the states where there is no personal state income tax. Okay. And you guys are lucky, I guess. And then sales tax, for example. Some states do not have sales tax, though it's not an income tax, but it is some form of a tax, definitely. And then goes the property tax. Some states have pretty significantly high 10 to 12% property tax, and some states do not have property, very less, maybe 0.5%, like South Carolina has 0.5% or 0.6% sales tax and property tax. But all in all, if you really look at some of these taxes, you can easily say here, pretty much like almost 35 to 40% of the pay or your income is going into taxes, some form of taxes already. Okay. But if taxes are one of the biggest expense, which we are not really seeing it, okay, feeling it today, but are we doing anything about that? Okay. A point to be noted here, point to be considered. But then comes your health insurance, then comes your mortgage, and then comes your rest of the things in life, like kids' education, shopping, vacation, anything, automobiles, everything, basically day-to-day living expenses, pretty much emergency expense, all those things come into picture. But if taxes are one of the biggest expenses, okay, why we are not seeing taxes as the biggest expense today? Okay. And if anybody is really looking into that, then what are they doing about it? That's where the key differentiation comes into picture. Okay. And as if we go back to the start of this slide, we were saying, hey, income and expenses, and then saving the money by reducing the expenses is a traditional way of thinking. But if taxes are one of your biggest expense, why are we not considering saving on taxes? Okay. Again, it's a mind shift, basically. That's where the difference of thinking comes into picture. So we have to think differently so that we make a difference to our families and society or community, definitely. And let me very confidently and 100% of the time say this: most of the wealthy Americans have been smartly managing their taxes. And greatest example is our past president, Mr. Trump. He pays zero tax. And some of the big folks like Amazon guys and then Elon Musk and some of these, smartly, they are taking the advantage of the IRS system and the tax codes and reducing their personal income taxes to as minimal as possible. Okay. So why not us? The law provides those provisions for everybody, and people, those who are smart and spending some time in doing that, they are going to save some money. All right. Let's look into some tax diversification. One of the key elements is how we can save on taxes and really increase our tax-free income is through some tax diversification. Let us see what avenues are available for diversifying our taxes. Pretty much when you really look into this basket, okay, these are the basically the tax now. That means you pay the taxes today through your W-2 or 1099 if you have some business, K1, C1 corp, all those things. You immediately pay taxes and then the income comes to you, basically. Tax later is a basket where you are investing or saving money That means you're postponing your tax liability for future. You're not paying any taxes today. You take a tax advantage little bit, not 100%, but you take a tax kind of a deduction there, and then you're postponing the liability for future event. Okay. So along with, if any money grows from this bucket, along with the growth, you're also growing your tax liability for a future event. Okay? Be cognizant of that, and so that you are taking care of that responsibility and you're making a provision to meet that responsibility or obligation to the IRS in future. Because IRS is going to come back and ask, hey guys, you invested in 401k and we gave you a tax deduction when you invested. And now you're taking out money at whatever the age, okay, 15 and a half plus, then you pay me the taxes at that time. You pay the taxes at the prevailing rate. Let's say today we are in, let's say 24 to 37% is the peak usually. And then within the tax range, if that tax range is going to be higher, let's say 40-45% or so, then you're going to pay at 40-45% when you withdraw that money from that basket. Not sure how many people are aware of the 50% penalty, because most of the people are saying penalty means, yeah, if you withdraw from 401k, we pay the penalty. That's only 10% penalty for early withdrawal, okay? But the 50% penalty, what we call it as a RMD, required minimum distribution, okay? Uncle Sam is giving the range, like eligibility to withdraw from 59.5, but he's not giving it open-ended, okay? By the time you start your retirement, like before 72.5, you should have started withdrawing the money from that basket, basically. Otherwise, Uncle Sam at the age of 72 comes back and asks, hey, you have not started withdrawing it. You pay 50% penalty on the balances available in that 401k basket at that time. Okay, so that's a pretty straightforward. And then the last, and what are the elements of 401k or IRA or SEP IRA, simple IRA, all those different types of IRAs where the tax deferment is taken, you are going to have that rule applicable from that basket. Then the last bucket is the tax advantage basket. Here you invest money for Roth, municipal bonds, etc., health savings account these days. And another product that we are offering is a life savings account, or what we call, okay? It's a tax advantage. So we'll look into some of these differences in the later slides, but at a high level, you know, this is how your tax dollars can be diversified. Okay? But many people may not even qualify for Roth, for example. If your income levels are, like for the current year, it's about $214,000 filing jointly. You may not even be eligible to put it into Roth bucket. Like, so what options do you have for after-tax dollar saving, basically, to take tax advantage for now or future? Because now is anyway you are paying after-tax dollars, but for future point of view. Okay, let's look into that. Then we will help to analyze how your tax dollars are diversified into your individual buckets, and then how that situation is unfolding as you start really looking into your own numbers later. Okay, let me put it this way. Then once the tax diversification is very key, but again, I would like to highlight here why we do the tax diversification. What is the significance of that? Okay, the correlation is very, very important from today to future. Again, always correlate this with the future or retirement, because this is where your wealth building strategy comes into picture. Okay, many of the deductions that we enjoy today, they are not going to be available for us when we retire. Like for example, 401k, for example, or the child tax credit exemption. Okay, this bucket is not going to be available. This avenue for tax saving is not going to be available, because when we retire, pretty much the kids are grown up. You are no more eligible to take the tax credit exemption at that time. Okay, so that avenue is kind of eliminated from the tax savings. Again, qualified plans contribution. There are 7 types of IRAs. Okay, let me put it that way. There are 7 types. And you, since you are not working actively at that time, there is no employer sponsored 401k at that time. Most of us may not be able to really qualify, invest money into that qualified plans at that time. Okay, so hence that tax revenue is not there for us. Even if you are retiring at 65, let's say, even if you are working and still contributing, you can only contribute till what? Like you have to start withdrawing before you turn 72. So your window is very minimal at that time. So those, when we retire, technically, we don't even have the option to take the deduction or saving, and then again immediately within 7 years you can withdraw it. So that is eliminated. Interest on mortgage. By the time we retire, we would have paid off our mortgages definitely, and then downsizing most of the time. So your kind of our mortgage is paid off. So your interest, whatever the deduction is people take, that is also pretty much gone. Charity, I mean, we have to take care of ourselves and our spouse basically, and then the donations to the charity, under which when you donate large sum of money for tax saving purposes, we may not be able to contribute so high dollars or high amount of money. So the avenues or the opportunities to really take tax advantages will be pretty much diminished when you really retire and really enjoy it. At that time, we are really looking at our retirement cash flow or how our money is going to be available and minimizing the taxes at that time. Okay. Most people think that we are going to have lesser income during our retirement, so we fall into lower tax bracket. I would say think again. Okay. You may not have lower income, number one. Okay. Number two, you don't know what kind of taxes you are going to be paying in retirement. So these two elements we have to consider when we are retiring. So it's important to really consider different buckets of investments also. Okay, besides the tax, how your investments are diversified. Okay. Let me ask you a tax trivia question. Please again use your chat window. Okay, it's free. What was the max tax rate in the US history? Okay. Maximum tax percentage, tax rate percentage in the US history. You have 5 seconds. Just type your questions. What was the maximum tax rate in the US history? Okay. We'll compile those answers later, but let me share here. When FDR was the president in 1944, okay, the individual income tax rate was 94%. Okay, that's right after the World War II. Okay, the tax rate has been increased to 94%. Okay, so whenever the country really needs money, the taxes are likely to be increased, and then that's the way. Even back in India also, when in the 70s and 80s, the tax rates were very high, duties were very high. But again, whenever the country needs high dollars or high inflation is going in, taxes are another way to be raised money for the government expenses to meet the government obligation. Okay. So, but can we, looking at the historical trend, can anybody project what would be the tax percentage 10, 15, 20, 25 years from today when we are all retiring and getting into that retirement? What will be the tax rate? Okay. It's very hard. Leave alone 10, 15, 20 years. We can't even predict what will be the tax percentage in 2024 or 25, couple of years down the lane. We don't know because it's expected, because in the last couple of years, a few trillions of dollars have been really printed and pumped into the economy to take care of whatever the pandemic situations and to really make up the economy to run on its own. There's a high rate of inflation. That's really, really the result of printing that high $1 trillion of money. And automatically, when such things are happening, the taxes are likely to be increased. Hopefully, if not this year already, I think Biden administration has announced it. And beyond that also, it is expected further taxes are likely to increase. Okay. Again, we have to correlate this information with what we were discussing previously, the three tax buckets. If the taxes are bound to increase, how well our investments and how our retirement is going to be looking. That's the critical thing. And again, from the investment diversification, not just the tax diversification, but our investments, where we are investing our dollars. Let's look into that. Okay. See how again, here, the question I'm posing first is how your tax dollars are diversified when I'm showing all the three different avenues here. Typically, one is a fixed investment. That means you are getting about savings bank or CDs or anything in those accounts. You're going to get a very minimal percentage. Okay. Probably today the inflation is high, interest rates are increasing, maybe 2.5, 3% CD the banks may roll out in the coming months or years, but savings less than 0.5%, 0.6% per year they give you. Okay, it's not a big deal. Technically speaking, the savings account money is losing its value because the inflation is higher than the interest rate that is sitting in the bank. Okay, so the time value of the money is actually losing. The dollar is losing because of the time value, and actually the money sitting in the savings account today probably maybe $1 today, probably in the 2 years time frame maybe 80 cents only because of that high inflation. Okay. Then the variable investments comes into picture where all types of stock investments, whether it be direct stocks, mutual funds, ETFs, or IRAs 5 to 9. Most of these are exposed to stock market. So this is a variable investment diversification. Okay, that means they are directly exposed to stock market volatility, and depending on how the market is moving, your balances in those accounts will also go up and down. Okay, couple of recalls here I would like to share. In 2007, 2008, it's not that long ago. Many of us are here, so we all seen like almost 40-45% of our 401k money has gone down. Technically speaking, it has gone from 401k to probably 201k. Okay, so that's the challenge with exposure to the variable bucket or the variable investments. Then comes our mixed bucket. So if you really look into this, many people are not aware what a mixed or hybrid bucket is or the investment style is. And this is where we bring as financial services professionals the value addition to your money and to your investment diversification portfolio, which is kind of again aligning to your tax diversification. Okay, so please think in this way. Pretty much in the fixed, when you deposit the money, whatever the interest you are getting, you get from Bank of America, wherever your banker is, CDs or any interest, you get a 1099. Okay, that's a tax you have to pay. Here also again variable, all the stocks, mutual funds, wherever it is, pretty much here, okay, which are exposed to variability. Some stocks, some mutual funds, ETFs, wherever you are trading, there's a capital gains possibly if you are really doing the transaction, and or if you're a long-term investor getting some dividends, probably if your dividends are, again, you have to report that as an income. So that's where. And then from the taxation point of view, besides the investment point of view. Okay, the mixed one, this is where the key difference comes into picture basically. If you really look at this chart here, the gray line here is pretty much mimicking the red line. Okay, the underlying, it is kind of exposed to the variability of the stock market, but the beauty in this case is it is locking out your downward. Whenever there is a downward trend happening in the market, it is locking out your gains till that point of time. Let's say somebody has started here, the market has grown, and then the market is going down, it's locked out here. So you can see whenever there is a downward trend, it's kind of a flat. So it's locking out. So that means you don't lose your investment, you don't lose your principal amount, plus the growth that has happened till that point in time, and it is locking out. That's the beauty of this mixed or hybrid investments. And that's where we bring in our value and our products and services to suit your requirement, to suit your family's requirement into this through these mixed bucket investments. Okay. Again, please check for yourself. I would say the analysis we have done in my experience, where I have done hundreds of analysis for families, okay, pretty much about 10% would be here, maybe more than 95 to 98% is here, and pretty much 0% is here. Hardly less than 0.5% of the people, okay, have invested or aware of such an investment is available. And most of the wealthy Americans are taking advantage of these things. Okay, why not us? Is a question I will leave on the table. Okay. Then let me share some insights here in terms of some contracts, which are kind of giving you the taste or insight into the market and the volatility and how the money can be kind of diversified or investments can be diversified. The red line is S&P and the green line is the alternate investments. You can say some of those contracts. We have mapped it out since 1997 and till as recently as till 2020. Okay, somebody has invested $100,000 and how that money has grown based on the S&P 500 index. Okay, obviously because of the market increase, it's growing significantly. And then you can recall the Y2K time, 2000, 2001, 2002, consecutive. This is historically consecutive 3 years downtrend. Okay, the money which was there from 100,000 went up to 150, and then well below your basic investments of 100,000 by the time 2002 came. So in about 5 years span, technically, okay, after 5 years, you lost about 7%. Okay, and then the market continues to grow. Again comes your housing market bubble in 2007, 8, 9, and then again it went up to 100. So pretty much what is it? Okay, you gained about 9,600, pretty much from 100,000 to 9,600 in what time frame? 97 to 2000. Wow, almost 11, 12 years. Okay, close to. Your money is still pretty much not making any significant growth. Okay, so this is a real example how your money can be really go through the volatility of the market. And then if you really compare that with the green one, which is a little bit of a lesser pace of growth, but it is steady. Okay, the reason, look at this year, basically here, let me show you the log here, how this money is flat. When the market is flat, crashing, your investment that has grown from 100 to 124 is locked out. It stays there. As long as it is negative, it stays at the same investment of 124,000 growth. But then when the market bounces back, it is bouncing back from 124 and it is taken a really a couple of steps ahead of the red line. Okay, and the red line is never able to catch up. So similarly in 2007, 8, and then we have to really look here also. There's a lack of space. We could not forward that animation. But here also again it's locked up. 348, when even 2020 March when the market fell. So these are some of the actual examples which we are showing here, which will help you to understand the concepts that we are sharing with you today to take advantage of the alternate avenues that are available with us. Okay. Now, this is the kind of a simplified way of explaining after 10 years of bull run, basically. Okay. Your growth, whatever the growth you have gained in those years, because most of the people do systematic investment plan of, let us say, $1,000 into every month into mutual funds, and annually they are investing about $12,000. Okay, it takes 10 years and 10% rate compounded. It is great, but suddenly after 10 years, 11th year, the market crashes by 20%. What happens? Your actual interest rate over a cumulative 11-year period is only just 4%. Okay, so all the gains that have gained in the 10, 11 years also can be wiped out, and your losses can hurt you more than the gains in the past decade. So we have to be cognizant again here, not to put all eggs into the one basket. Okay, pretty much, because why I'm saying one basket is anything that is exposed to the stock market, I would consider it as a one basket. Okay, 401k, which is kind of a indirectly, we are putting into directly 401k, but it is exposed to stock market. Maybe some of you are investing into 529 plans, but again, that fund is managed by a fund manager who is investing that money into 529. Okay, and then similarly, our own investments into stocks, our own investment into mutual funds. Pretty much, when we analyze it, we have found out about 98% of the people, their savings are 95% plus savings are into volatility basket. That's what I'm calling as a putting all eggs into one basket is not wise. We have to diversify into different investment baskets, which will also provide you a tax diversification advantage. Okay, so these are the points which you have to consider, and the underlying products and solutions can be easy once you understand these concepts. Okay. Again, let me remind you, if you have any questions, please put it in the chat box. We will answer them at the end. Now, having lost the money in those years, basically, let's look at the rate of return versus real rate of return. People think of, okay, I'm gaining in stock market, and okay, I gained 25%, I lost 15%. Okay, something like that, just as an example. But here is a hypothetical example I'm sharing. Let's say year one, you have invested 100,000 starting, and then you're losing by 50% at the end of the first year. Your net balance is only $50,000. Okay, but the year two, your opening balance is 50,000, but the market bounced back and gained 50%. So 50% growth happening only on 50,000, not on 100,000. So from 50,000 plus 50% is additional 25. So your ending balance at the year two is only 75. Still, the net delta is about $25,000, which is 25% loss actually. To recover your losses, you need 100% growth rate. Okay, to like first year 100,000, and at the end of the year after the first year loss, to recover that loss, you need 100% growth, which traditionally doesn't happen in any investment. I would say very rarely it might have. Okay, but the beauty is in our investments where we are showing such kind of a, when it is locking out at whenever the market goes down, you don't lose that balance as on that day. That's protecting you from the downward trend. Okay, so this is why we are saying in some of those contracts you will never have to recover from a loss, because your growth is going to happen from where you left or where you locked it out. You're not going to lose below your original investment of whatever it could be, the ground zero. Let me ask you a few questions here. Okay, most of you are investing money into stock markets and real estate or any other thing, but I'll lay out few parameters, and you don't have to answer. You can note down on your notebook or chat or wherever it is. I'll lay out 7 parameters, and which one is most appealing to you and why is it appealing to you? You can really answer for yourself. Okay, let's say any investment, for example, any investment wherever you are investing the money, what is important for you? Okay, especially from your time horizon and risk-taking ability point of view, and then what is your actual appetite for the finance or the growth or safety or anything like that. Okay, so here are the 7 parameters on which I would like to highlight. Okay, so which you can read for yourself, and then some of you may not understand some of the terms that I'm using there, but don't worry. It's not Greek and Latin, but we'll understand during the course of the presentation, definitely. So we all know when somebody is investing money, let's say, take an example of the first one here as a stock market. Okay, everybody would like to invest into stocks and they want with an ambition of growth. But while growing, please remember, you're taking some kind of a risk. Okay, so with that risk happening there, you may not be growing and you may lose probably, okay, lose your basic capital itself in the stock market. So you're compromising on the safety. And at the same time, yeah, there's an advantage whenever you want some cash out of the emergency, you can sell stocks and take the money probably the next day or the following day, whatever it is. That liquidity is available through the stock investments. Will it give any tax advantage? As we discussed, capital gains or dividend, there's no tax advantage. Income stream, yeah, if you have to live off your stock portfolio over a period of time in your retirement, you need to probably maintain a multi-million-dollar portfolio, but the underlying risk still be there for losing the investment value itself. But it might provide through large dividends, anything like that. A multi-million-dollar portfolio may give, but traditionally it's not possible. Okay. Third is, the next is about the living benefits. Most of you may not be aware, but just hang on, sit tight there. The stocks won't give you the living benefits. I'll share you in the next few slides what are the living benefits. And then tax-free legacy transfer. Stocks won't give you that benefit of tax-free legacy transfer to your next generation, obviously. And then comes your traditional real estate investments. Okay, except 2 greens, the rest everything is red. Because of the lack of time, I'm not going to explain everything, but yeah, real estate portfolio may give growth, and your real estate portfolio may give you income stream through the rental income. But please remember, again, it doesn't give you tax advantage, no liquidity, immediate liquidity, I would say, or living benefits, nor a tax-free legacy transfer. You have to create an estate, and then the estate, all those things will be coming into picture. But the third and final is addressing all the elements. Okay, will give you growth, it will give you the safety, it will give you the liquidity when you want, it will give you the tax-free benefit, tax advantage. There is a stream of income that can be made available over a period of long years in retirement. There are built-in living benefits. There are tax-free legacy transfers to your next generation. Okay, so hang on to that, and that's where we bring in value again as financial services professionals, and then share those information with you and design some of those things on one-on-one basis as required, analyzing each and every family aspects and family requirements. Then we'll recommend the suitable product or solution to you. And there is no obligation for that, but again, that's a solution available free of cost or anything for you. Again, when you are comparing different baskets, there's no one option that is best. Okay, each one has its pros and cons. Again, as I said, don't put all eggs into one basket. But if you're not taking advantage of this particular basket, then definitely you're losing on this. Okay, traditional way of investing is stocks, real estate, 401ks, IRAs, Roth IRAs, all those things. As we discussed, some of those IRAs, you may not even qualify with high income. Roth may not be an option for you for investing after tax dollars. Okay, so again, diversification is key, and not from taxation point of view, but investment point of view also. Both sides, it is a kind of a hand in glove, so it goes hand in hand. Then comes your wealth. Okay, building responsibility, wealth with responsibility. So when we are young, obviously we are energetic, and definitely our capability to earn more is obviously existing because of our age and everything. But at the same time, when you're young and the family, you have a lot of responsibilities for the family. Okay, let us quickly take a look at what are those responsibilities. Okay, we call them as dime, which is kind of a debt, whatever the debt, college debt or whatever it is, student loans. Income replacement, yeah, in case of job loss, we'll still be able to generate some responsibility income through alternate ways, and then we'll still meet those obligations in a way. But at the same time, we have to protect our income in some way or the other. We should be able to replace our income. Then mortgage protection, and then the education funding. Okay, please make sure that your family is appropriately protected and secured to address some or all of these requirements. Let's look at in detail what is the wealth with responsibilities when it comes to, let's say, some kind of a unusual, unforeseen things happening in the life. Okay, let's say our life has become too short, or unfortunate situation, somebody met with an accident or whatever. As you're going older, definitely your responsibilities are gone because kids are married off, mortgage paid off, you're getting into retirement pretty much. Okay, but the time is not on our side. Our earning potential also goes down along with the time as we retire. Okay, so that's another way. But what happens, suddenly we are in the middle of our lifespan and something happens, and we're not really kind of leaving this world, but we are disabled, we cannot work. Okay? In those situations, what happens? What happens to your income sources? Do you have a secondary source of income, or all your investments that are into your retirement accounts and everything, are they going to last for lifetime? Okay, because let's say in mid-40s or something happens, you're still going to live for a few number of years, but your responsibilities are still there. Your income potential has gone down. Okay, you cannot generate additional income with a disability, unfortunately. But what happens in those situations? The living benefits come into picture. Okay, I'm not sure. It's again a trivia question for you guys. Please feel free to post your answers if you know. But if you don't know, just leave it there. We will be able to address at the end. What are the living benefits? Okay, do you know anything about it? Whether you are a CPA or financial advisor or any tax planner, anybody has discussed with you guys what are the living benefits? Any time in your life. Okay, if you don't know, that's perfectly fine. We'll share what are those living benefits here. For the sake of time, I'm not going to stop or pause. But the living benefits are those which are available to each and every one of us through certain plans. You will be able to take benefit of those things while you are still alive. Okay, chronic, critical, and terminal illness benefits. Please remember, okay, this is not health insurance or anything. Okay, these are the living benefits through certain plans that are made available for the plan owner or the beneficiary of the, primarily the plan owner, okay, so who is owning. So these living benefits will come in very, very handy if something happens to us during the lifespan of the individual while we are living, while we are alive, and if disability strikes us, then these benefits are available to us. Let's say hypothetical case, yeah, nothing happens, hunky-dory, everything, life is smooth sailing, we are getting into the retirement. Through the retirement, the older people need the wealth protection, okay? They don't want to run out of money during their retirement, okay? These days, the average lifespan is about 88 to 89 years for females, and males is about 84 to 85 years. If you're living too long, the problem is probably running out of money for our retirement. Your 401k may not last beyond 15 years maximum if you're retiring, let's say around 60, 65, depending on the lifestyle and the tax rules, because you're going to pay taxes in retirement at the prevailing rate. Okay, let's say you are getting a benefit of 25% or 30% tax break today, but if the tax rate is going to be 40, 45%, you may be probably end up paying higher than what you gain here now. Okay, so that's the risk we are, and it also has a market risk. So then the other risk is the inflation. With all these risks surrounding us, if you're going to live longer, how you are going to survive in life, in retirement? That's the question I would like to ask. So do you want to be self-sufficient, or you want to depend on your children for the retirement? Okay, obviously, coming back from India here, definitely, having left our parents there, we would like to take care of ourselves rather than depending on our kids. Obviously, right? But that's a responsibility. While creating the wealth, you have to have some kind of a responsibility for your old age as well. Okay. So the responsibility, when we say, we look at some sources of income in retirement. Okay. What are our sources? 401k, obviously, Social Security, any rental income, any business or consulting income, part-time, maybe pension. These days, pension is a taboo word for most, but if your employer is giving you pension, you are the lucky one. And then some annuities probably, and some interest income or dividends, and then life savings account or LARP account. These are at least known to most of the financial professionals, but I would say that almost majority of them are taxable, except the one. Okay, why is it significant? Why I'm mentioning this tax every time is basically all your retirement sources of income or future tax rate is going to be applicable. Okay, again, with the US debt increasing into trillions of dollars, as of yesterday it's about $30 trillion. Okay, and then if tax rates are not going to be increased, how the government is going to really honor those commitments on the debt? So the saying is, okay, whenever there is an issue and the taxes are going to go high, and then you are going to pay higher taxes. Why not we look at tax-free accounts? Take the advantage of that. That's the message I would like to pass on today. Again, so inflation, as I was touching base quickly, because of the timing, I'm not going to pause here. Okay, the inflation in the 90s was average about 3.22% since 1990s to till recently. But in the last at least 6 months or so, the inflation has increased significantly. Okay, so in retirement, these are the risks that I was mentioning. Okay, you are living too long, market volatility risk on your accounts, inflation risk, and income stream, secondary income or steady income stream that is required. If somebody is retiring today, they may be good with living for $5,000, but 20 years from today, that $5,000 minimum requirement is going to be $10,000. Okay, and these numbers are with an inflation rate of about 3.22%. Assume that today the inflation is already close to 7.9 official number. Unofficially, probably it's close to 14 or 15%. What will this number be going to be? Okay, think on those lines. That's important for us to understand and really, really recognize the big challenge that is in front of us. Okay, so again, how many of us are really prepared to for a retirement life, addressing all these challenges that are going to come in front of us in the near future? Okay, so this is where I would again quickly run through the chart here. Okay, how your tax dollars are kind of diversified into different baskets, and what are the advantages. I would like to focus upon this pretty much because you guys know very well about this bucket and this bucket already, and this is where the tax advantage buckets will happen. Roth IRAs, again, most of us may not be qualified because we are all into higher income tax brackets already. Our incomes are more than $214,000 combined, so they may not be qualified. We don't have that option. Again, after tax dollars are invested and growth is 100% tax free, unlike these two buckets here. Okay, and then your IRS 10% penalty for withdrawals prior to the age of 10.5 is not applicable on this LSA only, but still in Roth and municipal bands this is still applicable. Okay, there is no limit on contribution for these LSA accounts. Only Roth accounts, probably you may not be able to contribute if you are like $7,000 is the max, and plus catch-up contributions for 50 plus maybe an additional $1,000 or so. That's all we are having on this bucket. Generally, typically these do not cause any RMDs, no excise tax or no minimum required distribution requirement. Okay, and it gives you the tax-free retirement income from this investment bucket. So this is where the differentiation comes, guys. So invest after tax dollars. Withdrawals are tax-free when you want it. That's the beauty of this bucket. So you can pay taxes today, don't pay taxes today, basically in this bucket, and pay heavy taxes in tomorrow. But pay small taxes, what is known to you today, and then be tax-free for rest of the life. That's the advantage in this bucket. Okay. Again, question is, don't put all eggs in your basket. How much balance you are making between these two buckets is important, and that's the analysis we can help you to do for yourself. Customization can be required. So it's another way of representation where tax deferred versus tax free comes into picture. It's a traditional IRA, any form of traditional IRA, where $0 on tax deposits, you bring in the money, no taxes, but the growth happens tax deferred, but you end up paying 100% of the tax on the total amount basically here. Okay, so at the prevailing rate when you withdraw it. Whereas in this bucket, let's say after tax deposits are made, it all grows tax deferred and you don't pay any taxes at that time. It's a Roth IRA, but same is applicable in case of LSA also. So that's where we are saying you choose which way you want to go. Let's say, for example, there's an early kind of a young employee whose income is very low. He may be better off paying taxes today and investing into this life savings account or Roth account directly. That way, he doesn't have to bother about paying taxes in future. Because his income is less today, then it's better off because he's automatically falling into lower tax bracket. It is better to pay taxes today on that smaller tax bracket and then save the money into this bucket. That's a smart way of balancing it and diversifying into the right buckets. Okay. Most of the tax consultants may not be doing it, but as financial services professionals, we give a comprehensive analysis on that, and then that's where we bring in the value again. That brings us into the last section today. I would say primarily from financial planning and wealth building point of view. It's college education, which is probably very dear to most of the people. Okay, it's the next phase in life. I would like to say most people start sweating about when it comes to the kids' college education, what to do, and all those things. But I would say enjoy the journey. Okay, I sent both my kids to college and be happy. But here the challenge is most of these modern, I would say ABCD guys are thinking, okay, who is going to pay for the college? Okay, So traditionally, there's been a survey, and about 40+% of the parents think that it is not their responsibility, but 70% of the kids think that it is parents' responsibility. So, but don't sweat it out, I would say. Rather than getting into that debate, if at all it comes at home, I would say probably you should teach them a better money management habits from the young age, so that they are kind of value the money and value the savings principles, or managing the money on their own. And there is a study done by Tiro Price, and they definitely say that about close to 50% of the kids, those who have been allowed to manage their money from the young age, when they are kind of into the elementary school itself, they are better off in college. Their performance is good in college. Their money management is better in life. So teach and inculcate those good habits in life for the kids when they are really young, actually. So give them a bank account or small, whatever the piggy bank account, and balancing it out and all those things. Teach them irrespective of, what age, unless they start going out of the home for college education. It's any time is better time, I would say. Earlier the better. So besides that, I have done some quick run on a typical case, a 10-year-old and going into Oregon State University at Corvallis College. Say, typically the college tuition is about $26,300, but all-inclusive college cost is coming to about almost $167,000. Okay, 10 years old, current age, starting age is 8 years from today, 18 years when the kid turns. That's going to be in 2030. The tuition is pretty much all including estimated total cost is about 167. What percentage of this 167 is being sponsored by parents? That's a separate question. But for the case here, I've assumed that parents tend to say, hey, we are going to sponsor 100%. Okay. And then the investment into whatever the bucket you are doing it, 529 plan or wherever you are investing. Okay. I'm just making an assumption here about $300 a month you are contributing today, and then your return is expected about 6%, and the average cost increase is going to be about 5%, maybe 3 to 5%. I don't know, because the inflation is high. I just kept it at 5%. With these numbers here, with these assumptions, you're probably the savings is not good enough beyond 1.5 years. You're going to probably cover only $52,000 of 167 grand. Okay, so the balance is the question mark, whether to go for loans, FAFSA, whatever scholarships, etc., or to meet the 100% requirement, somebody need to pump in another additional $600 a month. That way, it's about $900. Then you will be able to meet the obligation of the 167 grand. Again, we do this and we include this in our analysis for those who wants to do it. But again, this is a very basic tool, and we can do a deeper analysis on this for each family and each kid, depending on their age, in state, out of state, and all those. Okay. But here is a very generic chart that is giving you a public versus private college. Typically, private colleges are going to cost you very high, obviously. And then depending on when you are starting this, okay, at what age you are planning to start this contribution or savings into different plans, okay, the money investment per month can change, okay. But the question is, when do you start and where to save or where to invest? Again, please remember, your 529 plan, most of the people invest in 529 plans, okay. But in 529 plans, what is really allowed in terms of the college expenses? Okay? Only the tuition is allowed, books and supplies, computers, room and board, which are related to college expenses only. No transportation. In case the kid is going out of state, no flight is allowed to use. Flight expenses are covered through the 529 plan money. No health insurance is allowed for the kid. Okay, if it is on the parents' insurance, that's fine, but it's not allowed to use 529 plan money. Student loan payments, again, in 2019, through the Secure Act, student loan payments are allowed to be taken out only up to $10,000 from the 529 plan. Okay, again, think how much of money you are investing into 529 plan. What is the risk, underlying risk? Check your balances in 529 plan and see for yourself. Okay. Directly or indirectly, most of the money is invested in the stock market only, but all 529 plans do not have any FDIC insurance. Okay, if the money or the account value goes down, then you're not going to be claiming through any FDIC insured agency. No guarantee from banks, fund managers, or any state or federal agencies, basically. So you may end up losing the money from the 529 plan. I'm not saying it's not good, but the underlying risk in 529 plan, one must recognize and make sure that you're not investing 100% of your money into that bucket. Okay. But then why do people invest in 529? Just because of the state tax benefit only. Okay. For the state of Oregon, okay, if you're filing jointly, and only $300 per year is the state tax benefit you get. There's no federal income tax benefit on 529 investments. Okay. So even if you're investing, whatever the state limit is there, some states only have $2,500, $3,000, maybe $10,000, but Oregon state gives only $300 per year state tax benefit. But the underlying risk of your investment could be much higher, more than 300. Okay. So make sure that your investment is safe. But is there an alternate is a big question. I would say yes, there is an alternate which you have to share, definitely. I'm just making this chart very simple, comparing 529 plan versus the alternate plan, okay? And then look into that. Most of the people will see, you can read it for yourself here. The plan should be in child's name or something like that, but here it need not be in children's name, okay? This has to be used only for education and tuition. Doesn't have to be. You can use it for any financial need in life. Okay? Obviously, this has got stock market risk, volatility risk. There's a zero floor. So it will protect your capital. If you're investing $10,000, at least your $10,000 is secure in this plan. Okay. Liability, there's a potential tax and penalty if funds are not used for 529 plan or college tuition. In case a kid gets scholarship, both siblings are getting scholarships, legitimate reason. There's a big process to that. But in case you are not substantiating that thing, then you could end up paying some penalty and all those things. There's no penalties, no tax, because these funds are kind of used for any purpose other than college also. Okay. Even if kids get scholarships, it's easy. Don't use, don't take out the money, leave it there. It will continue to grow. You can use it for any of the life purposes in this plan. Same cost of investments, nothing significantly different. There's no protection, no benefit, obviously. There's a built-in protection on financial security available here in this plan. The biggest and most important is people think that by investing money into the 529 plan, they consider that the FAFSA loans or scholarships usually are not given to students. Okay, it's an experience. Let me put it that way. Depends again on the situation, individual situation. But most believe that by investing large amount of money in 529 plan, because you have to declare while filling the FAFSA application, what is the amount available in each of your accounts as a family. Okay. Let it be bank account, checking account, 401k, 529, anything like that. Here you do not have to report into the FAFSA application, guys. That's a big difference. So again, that may facilitate to get some scholarships by investing into alternate option. If you are really interested in knowing more, my sincere request is to text the letters FLS to this number for a free, no obligation, 60-minute free consultation. Okay. Those who are interested, please feel free. And there's absolutely no obligation to that. Just text FLS to this number, and then we can schedule a 60-minute consultation free of cost. And there's absolutely no obligation to that, guys. Okay. Again, that number is 503-750-3764. Here comes the last section, that's the estate. I think we are down to probably last couple of slides here, then we'll open up for questions. What is an estate? Basically, whatever a person owns, an individual owns, automatically an estate is created. Okay. But what is an estate planning? That means whatever the assets, the property or bank balance or stocks or anything, whatever the assets you own as an individual, whom you want to give it to, how you want to give it to, and when you want to give it to, and what portion of that you want to give it to. It's a distribution of your property or assets, basically, is kind of an estate planning. okay, in a simplified way, basically. If you do not have an estate plan, then the government will decide for you, basically. It's a very simple way of saying what is the estate planning. But then how to create it through a will, okay? A will is a legal document, nothing significant. And as a will maker, like say I'm making my will, then I would like to say the distribution is going to happen, how and when and what, okay? And every will has to go through the probate process, and there is a irrevocability and revocability in those things. And then if you are creating the trust, that's where this revocability comes into picture. Again, it's a legal document. Somebody will execute that will. It can be how your assets to be handled, in the sense in case you are incapacitated or you are not able to make certain decisions. So at a probate process and there are those things. There will be a trustee. If in case of minor kids, the trustee will take care till the kids are getting major, and then the distribution happens. Okay, it's important to have this will and trust in place, especially in US. Otherwise, the state government or the whatever the local government is going to take care of those things in case of any major thing happens to your family. But it is important to have that estate planning and will and trust. Similarly, the power of attorney, one is medical power of attorney and financial power of attorney. The medical power of attorney these days is important because in case of any incapacitation, you may not be able to decide while you are on the hospital bed or anything, then someone else need to make a decision on your behalf. Okay, that's the medical power of attorney. And then financial power of attorney is basically to make a financial decision on your behalf. You are entrusting that decision-making authority to somebody else. Okay, and HIPAA authorization is basically to receive your personal medical records and the health information to a third party, another person. You are designating them. Okay. As an individual, if somebody is in the hospital, they may not be able to make a decision, so they are authorizing somebody else to receive those information. That's important, especially from the US law perspective. Health insurance and HIPAA authorization is required. How to do it? Pretty much most of the companies these days offer through the employer. Take advantage of it if it's easy to handle and less cost, but they may not be able to cover everything in that the employer is offering. Second is do it yourself. We do offer that service through our own associate partner companies. It costs only up to $600 per family. It's a one-time cost, and there's a digital solution available as well as, you can fill up the pre-formatted templates, and then within less than a day, you can notarize it and then get it into up and running, basically execution of it. And if you go to attorneys, local lawyers, they may cost anywhere between $5,000 to $10,000 per family. And as you want to modify it later, it may cost you additional dollars also. Okay. Again, guys, it's time to take control. And here are the things which I would like to summarize. Change the way you are thinking so far about the finances. Okay. You have to make a paradigm shift in your thought process about the finances and personal finances and family security. And I would suggest always pay yourself first. Consider your family as the priority before you have other obligations. Okay, before you want to meet any other obligations you may have, put yourself and your family first. Okay, adjust your lifestyle. Don't go for extravagance in these uncertain and dynamic, volatile times. And define and differentiate between what you want and what you need, and set priorities for developing a disciplined financial lifestyle. Most of us plan for a lifestyle, but very few people plan for a financial lifestyle. It's important. It's high time that people put and consider that financial lifestyle plan also into place. Avoid the credit trap. Don't use the plastic money. Very simple. Most of us don't. But I would pose a very thought-provoking question here, or a solution probably is kind of a alternate way of thinking. As I said, start earning additional income. Okay, it's always recommended to have multiple sources of income rather than depending just only on one salary or two salaries in a family. Okay, not just the job, but try to think differently and start developing some additional income source. Okay, again, next steps, as I said, my commitment or our commitment to you is definitely we'll provide a free financial solutions to the people who have attended, and please text us. And we'll identify the strategies that would suit your requirement to meet your financial goals in life as a family. Okay. and we'll create a financial pathway for financial independence, which also provide you the time freedom over a period of time. Okay, and the build and plan for generational wealth building strategies. And since Ramesh Mamta is our local contact there, I would appreciate if you guys reach out to Ramesh and then send an email or call him on this number, and we can plan for a one-on-one basis, a financial independence plan free of cost. Okay. Again, as a last comment, passing comment, as Warren Buffett mentioned, if you don't find a way to make money while you are sleeping or vacation, you will work until you die. What he meant basically is to generate an alternate source of income. Okay, so that income is passively working for you or generated passively, even if you are not actively working at that. Okay, that's a way to look at it. So we provide an opportunity and to generate that alternate source of income, and we provide free training. And again, please contact Mr. Ramesh, who is locally available, so that he's available just a phone call away or a 5 minutes drive or whatever the local access you may have. Okay. With that, I end my presentation. Thank you very much for your attention and time. And if you have any questions, please feel free to post, or you can open the mic, Sridhar Garu. We can take the questions.
Yeah, either paste your questions in the chat, or you can unmute yourself and ask the question yourself. Absolutely. So maybe I'll ask the question, Manohar Garu. So in terms of so you obviously mentioned the benefits of a solution that you're suggesting, but in terms of an overall financial plan, is your thought process to lean more towards the solution you're suggesting, or to have a more structured balance across the three areas that you suggested, right? So taxable, tax advantage versus tax later, right? So
yeah, good question, Andy. So traditionally, so far we have been focusing only on the first two buckets. Traditionally, sure. Okay, one is kind of a savings in the bank, and then second is savings for retirement through employer-sponsored accounts, and also probably to a large extent in stocks and stock market investments from investment point of view. But both the third options were not explored in investments as well as in taxation. Sure. Okay, so the way we do it is not just our product only, but we analyze completely a comprehensive financial lifestyle plan. We analyze it, and based on that, we make recommendations. I'll give a very simple example, like HSA. Okay, when we started analyzing it, many people were not even aware that there's something called HSA existing. It's very surprising and very shocking. And second point I would like to share is many people not even logged into their 401k accounts for the last 7-10 years. And their accounts are kind of, they are working for the same employer for 15 years, but they're never logged into their accounts. So it's really shocking sometimes how people are taking care of their own, retirement money. They have a underlying idea that, okay, we'll go back to home country and stay there. But the money that you are contributing to 401k is your hard-earned money, and there is a free money that is contributed by the employers. Okay, and people don't even log into those accounts. And is it happening to majority of the people? Probably not. But there is a segment of the population that is still, I would say, highly enigmatic in terms of the knowledge, I would say. So to answer your question, very simply, we probably should do the financial analysis or the lifestyle planning, and then we'll address, okay, how your numbers are fitting into those buckets. And then we come up with a recommendation.
Makes sense. And good that you touched on HSA, because that's one thing that I was going to bring up. Is HSA is one of those unique investments where you send money in tax-free, it comes out tax-free. So
yes, there you go. And how many people are really taking advantage of that for the family? Like probably this is close to about 7.5 or close to under $8,000 per year these days.
Correct. Yeah.
For the family. So if you are into the 30% tax bracket on $8,000, you can calculate that. It's a simple math.
Yep, indeed. Any questions for Manohar Garu?
I have a question, Andy. This is Siri Malabi. Thanks for the nice presentation, firstly. But my question is, you talked about many different aspects, Kadandi, like for getting your finances in line and everything. But if you were to like, say, put them in order of priority or something like that, how would you go about it? Because there are several different aspects you talked about here, including will and trust, like what Sridhar was asking about, the different kind of tax brackets, and all of that. How would you prioritize, step 1, step 2, step 3, go, what comes first to look into a good financial plan?
So, okay, there's no set rule. Let me put it this way. Okay, first and foremost is what's your objective? Okay, every family or every individual have some short-term to mid-term goals and then the long-term goals. We need to understand every family situation, which is different completely, and depends on family size, kids' ages, and then single income, double income, so many things, status, all those things come into picture. So hypothetically, let us say somebody has very young kids under 10 years old, just giving an example here, okay? Under 10 years old, and they have a huge mortgage and certain liabilities. They don't even have any kind of protection, for example. What is lacking there? What is the risk, underlying risk? Number one. Second is they have a plan to go back to India, let us say. So they don't even contribute to 401k, okay? And they don't even take advantage of company's contribution. The company employer pays 5% free money. If you contribute, let's say 6%, company contributes 5%. They don't even contribute 6% nor 5%. They take the advantage. So each situation is different. That's why I would say, what is your objective? And for that, we have to do that analysis or the lifestyle planning. That way we'll be able to come up with certain recommendations only after knowing it. Otherwise, what happens, it's not a cookie cutter approach, like one size fits everybody. Hope I'm able to give you some kind of a, answer there. But if you're really looking at prioritization, again, I don't want to give any solution which will be misguiding without knowing the complete background from that perspective,
Right, makes sense. It has to fit individual needs for that family, is what
Absolutely.
you're saying.
Absolutely,
Okay.
exactly. Yeah.
Makes sense. Thank you.
So looks like, go ahead.
Yep.
So looks like there are no more questions. Thank you for the wonderful presentation, Andy. So, and I'm sure as folks have questions with the contact information they're provided, they'll reach out and they can go into their specific details. Thanks a lot, Andy.
Yeah. Thank you very much for your attention and the opportunity to share my thoughts. And anytime, please feel free to reach out to me or Ramesh. And thank you again.